If you're both self-employed and employed at the same time, your tax situation gets a bit more complicated, and small mistakes that you make in reporting could cost you big time in taxes. So how does it actually work when your payroll job automatically calculates and applies deductions, but your side hustle doesn't? Well, in this video, I'm going to break down exactly how you'll be taxed, the common mistakes people in your situation often make, and how to maximize your take-home income. So first up, let's talk about how HMRC looks at multiple income streams. If you're employed, your tax is deducted at source through PAYE, so that's short for pay as you earn. That's why on your pay slip you'll see deductions for tax, national insurance, pensions, and possibly student loans, which can add up to a significant amount, and that makes what you're actually paid in your salary quite a bit lower than what you actually earned. If you're self-employed, you pay tax through self-assessment, and the actual period covered each year is the 6th of April to the following 5th of April, the same as your payroll year. However, the difference comes in when you pay taxes and national insurance, as it's in one lump sum for self-employment, and the deadline for payment and filing is the following 31st of January. Any later than that, and penalties and interest will apply. But here's the catch. HMRC doesn't consider and tax these separately. They combine your total income and calculate your tax accordingly. Now that means your side hustle income could push you into a higher tax bracket without you realising, and you'll owe a shocking sum of cash to HMRC come the self-assessment deadline. And a pro tip is always report all income streams accurately to avoid penalties. And yes, even that couple of months dabbling as a freelancer on Upwork. So let's talk about your actual employment, the PAYE job, and some of the potential tax code traps. Your employer might actually be deducting more tax than they should without you even realising it. When you register as self-employed, HMRC might adjust your tax code on your pay slips. And what you need to do is look out for something like BR or D0 in your tax code, because that could mean all of your salary is being taxed at 20% or even 40% out. Emergency tax codes can also lead to you paying too much. Look out for a W1, M1 or X after your tax code, which generally means week 1 or month 1 basis. We recommend logging into your HMRC account and regularly checking your tax code, and you can check your tax code using the link in the description below. Now that leads us into national insurance, an extra cost that most people forget. When you're self-employed as well as employed, you might think, well, I'm paying NI through my PAYE job, that's all sorted. But that's actually not the case. As an employee, you pay Class 1 national insurance contributions through your PAYE. As a sole trader, if your profits are over $6,725 or more per year, you also pay Class 4 national insurance contributions, and that's 6% on profits between 12,500 and 50,000. And then there's 2% on profits over 50,270. If your profits are less than 6,725, you don't have to pay any NICs. However, depending on your PAYE income, you might want to voluntarily pay Class 2 national insurance contributions, and those are £3.45 per week. But what it does is it safeguards your pension contributions. And 2 good tips. Number 1, and this is an important one to remember, you'll typically need 35 qualifying years of contributions to qualify for the full state pension. It does depend on your age. Number 2, always account for NICs, national insurance contributions, in your budgeting. Many forget and think they'll just pay their 20% income tax on profits, leaving out the additional 6 to 8%. So you might be asking, well, how can I reduce all these extra taxes and deductions to the self-employed of my income so I don't have a magnitude 8 bill from HMRC at the end of the tax year? 2 simple words: claimable expenses. You might be paying for business costs out of your own pocket when you could be getting tax relief instead. If you're self-employed, you can deduct business expenses to reduce your taxable profit, because that's the bit that goes on your tax return. There are claimable expenses such as hardware, software, travel, phone bills, even a portion of your rent or mortgage as part of home office costs. Then also look at splitting expenses. If something is used for both personal and business, like your phone, you can claim a percentage of it. You can learn more about claimable expenses by checking out the video that's linked in the description. That's really good for that. Oh, and we'd love to know if we'd earned your subscription to our humble little channel. We're releasing videos every Friday, giving away all our team's best accounting knowledge and tips without hiding it behind a paywall. Anyway, let's move on to another way you may be able to get some tax relief, which is through VAT. Even if your business is tiny, it might be beneficial to register voluntarily for VAT. If your self-employed income exceeds $90,000 in a rolling 12-month period, you must register for VAT. You don't have a choice, it's compulsory. But even if you don't hit that threshold, voluntary VAT registration can benefit you if you buy a lot of goods. Anything you pay VAT on, you can claim back. So every purchase you make through the business will reduce your cost by 20%. For example, if you buy a new computer, you can claim back the 20% VAT you're paying on it, and the net value still goes into your accounts as a tax deductible expense. Watch out though, and consider carefully, as depending on your trade, you are expected to also charge 20% on your prices. So you need to account carefully for this change if you do choose to register. So what happens once you've submitted your self-assessment tax return? Well, many side hustlers usually get a nasty surprise on the 31st of January, but I'm going to tell you how you can avoid that. The most crucial thing you'll need to know is that HMRC operates a payments on account system where they assume you'll earn the same next year, and they ask for an advance payment, one in January, one in July. Now, if you've made good money in your first year of self-employment, this can double your tax bill, as they're going to ask you to pay the actual tax and NI plus 50% of that total in addition towards the following year's tax bill. So it's usually best to plan and set aside at least 20 to 30% of your side hustle income, and that's before you've deducted any business related costs. Put that to one side for tax, and this could mean avoiding a larger tax bill in the future as well. And also look out for getting your tax bill done as quickly as possible, so you know ahead for that 31st of July second payment on account. Now, let's talk about your business structure. At a certain income level, staying a sole trader could be costing you thousands. As a sole trader, you pay income tax and national insurance contributions on all your profits. With a limited company, you pay corporation tax, which is 19% on profits below 50,000, and you can choose what you then take out and pay tax on as additional income for yourself. However, there are extra admin tasks and costs like accounting fees and filing fees, courtesy of Companies House. As a rule of thumb, if your side hustle profit after costs is taking you into the higher rate tax when it's added to your PAYE income, then consider a limited company to give you a bit more flexibility and also tax savings. Finally, you need to consider how your side hustle impacts your employment rights, plus other areas. For example, think about sick pay and maternity pay. If you're employed, you're still eligible. But if you go full-time self-employed, there is no sick pay, and you'll need to claim maternity allowance instead. And then there's mortgages. Now, usually lenders want 2 years of stable self-employed income for approvals. So this is a really important consideration if you're looking to purchase a property in the next few years. So If your side hustle is taking off, it's worth talking to an accountant, as the right advice and tax strategy could save you thousands. Thanks for watching, and I'll see you in the next one.